Welcome to the world of investing. Investing. It's a word that can spark both excitement and fear, often at the same time. But you see, it's not as complicated as it seems. Imagine you have some extra money each month. Instead of letting it sit idle, you can invest it. This means putting your money to work for you, allowing it to grow over time. Think of it like planting a seed. You water it, nurture it, and over time it grows into a strong tree. Investing helps your money grow faster than a savings account. It's your ticket to achieving your financial dreams, whether it's buying a house, retiring early, or securing your children's future. But where do you start? Two popular options are ETFs and mutual funds. Think of them as two different ways to enjoy a delicious meal. Both offer diversification, spreading your investments across different assets like stocks and bonds. This helps manage risk, just like eating a balanced diet keeps you healthy. In the following sections, we'll break down ETFs and mutual funds, exploring their pros and cons. By the end, you'll have the knowledge to choose the best investment strategy for your financial goals. Let's get started. Moving on to ETFs, or exchange-traded funds, which are like a personalized investment platter. Imagine walking into a restaurant with a vast buffet. You choose the dishes you want, creating a plate tailored to your taste. That's what ETFs offer: flexibility and control. ETFs are baskets of investments, like stocks or bonds, bundled together. You buy and sell ETF shares on stock exchanges, just like individual stocks. Want exposure to technology companies? There's an ETF for that. Prefer renewable energy? There's an ETF for that too. The beauty of ETFs lies in their flexibility. You can buy or sell them throughout the trading day, giving you more control over your investments. Need to adjust your portfolio quickly? ETFs provide that agility. They also tend to have lower fees than mutual funds, as they are passively managed. This means they track a specific market index or sector without requiring constant intervention from a fund manager. This lower management cost can translate into higher returns for you over the long run. ETFs empower you to be an active participant in your investment journey. You can tailor your portfolio to your specific interests and risk tolerance, choosing from a wide array of options. Just like creating the perfect meal from a buffet, ETFs allow you to handpick your investments and create a portfolio that aligns with your financial aspirations. Now let's move on to mutual funds. Think of them as a carefully curated investment menu. You choose a preset meal crafted by expert chefs, in this case, fund managers. Mutual funds pool money from multiple investors to invest in a diversified portfolio of assets, such as stocks, bonds, or real estate. Each mutual fund has a specific investment objective, like growth, income, or a combination of both. Fund managers actively manage these portfolios, buying and selling assets to achieve the fund's goals. They're like experienced chefs, selecting the best ingredients and adjusting the recipe as needed. Mutual funds offer diversification and professional management, making them suitable for investors who prefer a hands-off approach. You entrust your money to experts who make investment decisions on your behalf. They provide convenience and a structured way to invest in the market. However, this convenience comes at a cost. Mutual funds typically have higher fees than ETFs due to the active management involved. These fees can impact your overall returns over time. Additionally, you can only buy or sell mutual fund shares at the end of the trading day, unlike ETFs, which trade throughout the day. Section 4. Fees and expenses. The cost of dining. When comparing ETFs and mutual funds, it's crucial to consider the fees and expenses associated with each option. Think of these as the cost of dining at our investment buffet or restaurant. ETFs, with their passive management style, are like a casual buffet where you pay a lower price for the freedom to choose your dishes. Mutual funds, on the other hand, are like a fine dining restaurant with higher overhead costs. You pay a premium for the chef's expertise and the curated dining experience. These costs come in the form of expense ratios, which are annual fees charged by the fund to cover management fees, administrative costs, and other operating expenses. Expense ratios for ETFs are typically lower than those for actively managed mutual funds. This is because ETFs don't require the same level of active trading and research as mutual funds. Over time, these seemingly small differences in fees can significantly impact your investment returns. Remember, every dollar you pay in fees is a dollar less that's working for you. When evaluating investment options, pay close attention to the expense ratios. Even a small difference in fees can have a substantial impact on your long-term returns. Choose wisely. Section 5. Choosing your investment feast, ETFs or mutual funds. So how do you choose between ETFs and mutual funds? It all comes down to your individual needs and preferences. ETFs, with their flexibility, lower costs, and intraday trading, are like a buffet that caters to a variety of tastes and preferences. They're ideal for hands-on investors who want to build a diversified portfolio tailored to their risk tolerance and financial goals. You can pick and choose from a wide range of options, adjusting your holdings as needed. Mutual funds, on the other hand, are like a carefully curated dining experience suitable for investors who prefer a more hands-off approach. They offer professional management and diversification, taking the guesswork out of investing. Consider your investment goals, risk tolerance, and how involved you want to be in managing your portfolio. If you're comfortable with a hands-on approach and prefer lower fees, ETFs might be the right choice. If you prefer professional management and a more structured approach, mutual funds could be a better fit. The key is to understand the differences between these investment vehicles and choose the one that aligns best with your financial objectives. Section 6. Conclusion. Bon appetit. Enjoy your investment journey. Investing doesn't have to be intimidating. Whether you prefer the flexibility of ETFs or the convenience of mutual funds, there's an investment option out there for everyone. Remember to do your research, consider your investment goals, and choose a strategy that aligns with your risk tolerance and financial aspirations. Think of it like embarking on a culinary adventure. You have a world of flavors to explore, each with its own unique characteristics and appeal. The key is to savor the journey, make informed decisions, and enjoy the fruits of your investment labor. Just like a well-balanced meal nourishes your body, a well-diversified investment portfolio nourishes your financial future. So, go ahead and explore the investment buffet or indulge in the curated menu. Bon appetit! May your investment journey be both delicious and rewarding.